You know those old antique maps? The ones with the really thick, definitive black ink lines separating the land from the ocean?
Oh, yeah, the really
Mm.
classic, detailed ones.
Right. You look at them and the boundaries are just absolute, this is the land, this is the water, and it's comforting, really.
It's orderly.
Exactly. But imagine if someone spilled a glass of water right in the middle of that map.
Oh, man, the ink just bleeds everywhere.
The lines completely blur together. Suddenly, you can't really tell where the shoreline ends and the sea begins. It all just becomes this murky, interconnected wash of color. And honestly, that is exactly what it feels like looking at the global landscape today. The map is wet, and the lines are just completely bleeding.
It's a visceral way to look at it, but I mean, it's incredibly accurate. We naturally crave categories,
I
really.
really do.
We want a chip maker to just make computer chips. We want an airline to just fly airplanes. We want a movie to just be a movie. But today's stack of sources tells a radically different story.
Okay, let's unpack this. Our mission today is to take a stack of the most critical updates crossing our desks, spanning geopolitics, enterprise tech, and even global pop culture, and really find the hidden threads connecting them for you.
Yeah, and the theme that keeps jumping out of the material for you today is exactly what we just described: collapsing boundaries.
Completely disintegrating.
We are watching the lines between suppliers and competitors, between physical and digital infrastructure, and even between fictional and real-world success just, well, vanish.
Yeah. And we have to start with the physical world, where a sudden geopolitical shockwave is forcing entire global industries to adapt their boundaries instantly.
Right.
So Thursday saw global stock markets take a heavy hit after Iran called for the Strait of Hormuz to remain closed.
To understand the immediate market panic there, you really have to look at the mechanics of that specific waterway. The Strait of Hormuz is a massive geopolitical choke point.
It's tiny, right?
It's incredibly narrow. Roughly 20% of the world's total global oil consumption passes through a channel that is only 21 miles wide at its narrowest point.
Wow.
So when you threaten to close that valve, the supply of oil to the global market is mathematically slashed in an instant, but, the world's demand for energy doesn't change at all.
People still need to drive, planes still need to fly.
Exactly. So the domino effect is violent. Brent crude surged over 8%, instantly topping $100 a barrel. And when energy prices spike like that, it awakens the ultimate nightmare scenario for central banks, which is stagflation.
And we should probably clarify why that specific scenario just paralyzes the Federal Reserve. Stagflation is that brutal combination of a stagnating economy and skyrocketing inflation.
It's the worst of both worlds.
Right. If the Fed sees inflation rising because oil is at $100, their traditional weapon is to raise interest rates to cool the economy down. But if the economy is already stalling out, raising rates will choke it completely and trigger a severe recession. They're just trapped.
Precisely. They have zero good options here. I mean, traders had spent the early part of the year pricing in multiple rate cuts.
Yeah, everyone was waiting for those.
But now, that oil shock has completely upended the math. The market is bracing for the Fed to stand pat on rate cuts until at least September.
If even then.
Right. There's even serious talk bubbling up in the data that we might see zero rate cuts in 2026. This single geographic choke point half a world away has fundamentally altered domestic monetary policy, and the broader market felt it instantly.
Yeah, the S&P 500 took its third straight loss, falling 1.5%. That puts the index at a low for the year, down 2.5% overall.
It's a heavy hit.
And nowhere is the fragility of this global supply chain more obvious than in the airline industry. They were absolutely hammered by these fuel cost fears. Southwest Airlines fell 6%. American Airlines and United Airlines both dropped 4%.
Naturally, fuel is their biggest expense.
But here's a detail from the financial reports that really stopped me in my tracks. Delta Airlines only fell 2%. And the reason why is a perfect example of our theme today. Delta actually owns a massive oil refinery in Pennsylvania.
What's fascinating here is how it acts as a brilliant financial shock absorber. While the rest of the airline industry is entirely at the mercy of the open commodities market, Delta has fundamentally blurred the boundary between being a transportation company and an energy producer.
Walk me through the actual balance sheet mechanics of that, though. Like, how does owning a refinery physically stop them from bleeding cash when oil hits $100 a barrel?
Think of it as an internal financial hedge. A refinery buys crude oil, refines it, and sells products like jet fuel at the going market rate.
Okay.
So when crude oil prices spike, the cost of jet fuel skyrockets, meaning the airline division of Delta is suddenly paying a fortune to fuel its planes and is losing money.
Right. They're taking a bath on fuel.
Exactly. However, their refinery division is now selling jet fuel at those sky-high premium prices, meaning the refinery is suddenly printing cash.
Oh, I see.
Yeah, when Delta consolidates their quarterly earnings, the massive profits from the refinery side effectively cancel out the painful losses on the airline side.
It's like a commercial baker deciding to buy the wheat farm and the flour mill.
That's a great way to put it.
Right. When a global flour shortage hits and bankrupts all the competing bakeries, our baker's mill is generating so much profit, selling whatever flour it has, it covers the bakery's losses. So, does this mean extreme vertical integration is going to become the new mandatory survival tactic?
It's looking that way.
Like, if you're a massive corporation, do you now have to own every single piece of your physical supply chain just to survive these macroeconomic jolts?
It certainly points in that direction. When you can no longer trust the stability of the global open market, your only real defense is to bring the market in-house.
Bringing a supply chain in-house is one way to survive. But what about the companies that physically inspect, test, and certify those very supply chains?
Yeah.
Because while airlines are incredibly vulnerable to commodity chaos, there's an entire hidden layer of physical infrastructure companies designed to churn out steady cash, regardless of macroeconomic panics. Let's look at tech solutions.
Right, TITEC. That stands for Testing, Inspection, Certification, and Compliance. They are the ultimate behind-the-scenes operators.
The unglamorous stuff.
Oh, totally. They test the structural integrity of concrete on new bridges, they certify the safety of power grids, they inspect pipelines.
But even the inspectors aren't immune to market turbulence right now. Their stock dropped a massive 13% today following their fourth quarter earnings release.
Yeah, that was a steep drop.
Their revenue came in roughly flat at $508 million. Now, digging into the sources, part of the messiness here is that they are dealing with a transformative, highly complex merger from last fall between their legacy operations, Acuren, and a massive engineering firm called NV5 Global.
Which, mergers of that scale always create a muddy balance sheet for several quarters.
I've never clean.
Never.
Yeah.
You are integrating two different accounting departments, overlapping software systems, and redundant personnel. Plus, they explicitly reported that while demand from data centers and infrastructure is very healthy right now, it's being heavily offset by temporary federal funding freezes and some very soft demand from their traditional Gulf Coast clients.
And to top all of that uncertainty off, they're going through a massive changing of the guard at the executive level. CEO Tal Pizzey is stepping down after an incredible 40 years at the company.
40 years is a lifetime in that industry.
It really is. He's being replaced by the current COO, Ben Harrod, who notably ran NV5 Global before the merger. But I have to push back on Wall Street's reaction here. A 13% drop feels wildly disproportionate. Are investors just missing the forest for the trees because of a messy transition quarter and a CEO swap? The research explicitly notes they have massive secular tailwinds behind them.
It is a classic market overreaction to short-term noise. I mean, investors hate uncertainty, and a new CEO combined with a complex merger is the definition of uncertainty.
Right.
But you mentioned secular tailwinds, and that is the key to understanding Kisaig's actual value. Secular tailwinds are massive structural shifts in the economy, like renewable energy expansion, grid modernization, and digital transformation.
Things that are happening regardless.
Exactly. They happen completely independent of whether the stock market is up or down, or whether oil is at $70 or $100.
Because the physical world still has to be inspected by law.
That's the moat. Because their services are required by strict federal and state regulations, they operate with a massive financial cushion. Even if federal funding freezes temporarily or the Gulf Coast market softens for a quarter, that essential, unglamorous work must go on.
You can't just skip inspecting a natural gas pipeline because interest rates are high.
You'd hope not.
Huh.
The regulatory compliance boundary protects their core business model.
So physical infrastructure is strictly regulated and moves methodically, even when the balance sheet gets a little messy. But let's take that concept of infrastructure and pivot to the digital world. Because if TISTIS is the unglamorous physical foundation of the economy, we are about to look at the most highly valued digital infrastructure on Earth. And they are completely tearing up the map.
We are, of course, talking about Nvidia.
Nvidia. Here's where it gets really interesting. Nvidia is officially planning to invest a staggering $26 billion to build its own open-weight AI models.
which is just a massive pivot.
Huge. This puts the chip giant in direct head-to-head competition with its own biggest customers, heavyweights like OpenAI, Anthropic, and DeepSeek. They're leveraging their total monopoly over compute infrastructure alongside 2 years of quietly acquiring top-tier AI research talent. CEO Jensen Huang is now publicly declaring Nvidia a full-stack AI company.
Full stack is the defining phrase there. That is the ultimate collapsing of a boundary. For years, Nvidia was the neutral arms dealer of the tech world.
The Switzerland of AI.
Right. They provided the underlying chips, the GPUs, that allowed everyone else to build artificial intelligence.
It's like the company that builds the casino and leases out all the slot machines, suddenly deciding to walk right onto the gaming floor, sit down at the high roller table, and play against its own clients using an unlimited stack of house chips. Is breaking this unspoken Switzerland of AI infrastructure rule a massive act of corporate hubris?
If we connect this to the bigger picture, the broader history of technology, it is a flex of pure scale that mirrors Apple's playbook.
How so?
Well, Apple doesn't just make the iPhone's physical casing, right? They make the operating system, the proprietary software, and the silicon chips inside it. Vertical integration allows for total optimization.
Ah, I see.
Nvidia is looking at the AI landscape and realizing that since they literally control the hardware bottleneck, they have a terrifying advantage in building the software. Let's look at the financial math you mentioned. $26 billion.
Right, the scale of that budget is almost hard to comprehend. To put it in context for you listening, OpenAI reportedly spent somewhere around $3 billion to train GPT-4. Nvidia is dropping $26 billion over just the next 18 to 24 months.
It's an astronomical sum.
It completely dwarfs what the current industry leaders are spending on research and development.
And here's how they achieve that. Nvidia doesn't have to pay the massive profit margins to buy the chips because they make the chips.
Oh, of course. They get them at cost.
Exactly. That $26 billion goes infinitely further for them than it would for anyone else. They can feasibly develop multiple frontier models simultaneously and, crucially, optimize the software architecture specifically for their own proprietary hardware. And their deployment strategy is very clever. They are building open-weight models.
I want to clarify that term because the distinction really matters. Open weight sits right in the middle ground between two extremes. On one side, you have OpenAI, which operates a totally closed, black box ecosystem. You only get to see the final output.
Right, you can't see under the hood.
Exactly. On the other side, you have Meta's Llama series, which is largely open source, giving away the underlying recipe. Open weight means Nvidia will publicly release the pre-trained neural network, the actual heavy lifting of the model, but they keep some of the underlying training data and specific architectures proprietary.
It's a strategic sweet spot. It allows developers to build on top of NVIDIA's models freely, which drives mass adoption, while NVIDIA still retains control over the core intellectual property.
And the financial upside of capturing that developer ecosystem is absurd. Analysts in our sources estimate that if NVIDIA captures just 10% of the foundation model market, it could generate $50 billion annually in high-margin software revenue within 3 years.
And their first major releases are aimed at late 2026 or early 2027.
But there is a massive existential risk here, isn't there? NVIDIA's 3 largest cloud customers, the ones buying all those chips, are Microsoft, Amazon, and Alphabet's Google. And all 3 of them are heavily invested in the very AI model providers NVIDIA is now trying to crush.
That is the multi-billion-dollar gamble. By becoming a direct competitor, NVIDIA is essentially forcing hyperscalers, those massive cloud providers operating data centers on a planetary scale, to completely rethink their dependencies.
It has to make them nervous.
Absolutely. It forces Microsoft and Amazon to accelerate the development of their own proprietary AI chips so they can sever their reliance on NVIDIA's hardware. One AI executive, quoted in the sources, put it bluntly, "You can't be both the Switzerland of AI infrastructure and a direct competitor." The boundary between critical supplier and mortal rival has evaporated.
And when NVIDIA walks onto the casino floor to compete, those hyperscalers have to look for entirely new territory to conquer. Microsoft is not just sitting around waiting for NVIDIA to eat their lunch. They are busy pushing their own AI capabilities out of the data center and into the most intimately physical territory possible, our vitals.
Yes, the launch of Microsoft Copilot Health. This is a dedicated health assistant portal built directly into their consumer chatbot ecosystem.
Well, how does it actually work for the user?
Well, U.S. users can now upload their comprehensive medical history, their lab results, and real-time biometric data from wearable devices like smartwatches.
Microsoft's consumer AI chief, Mustafa Suleyman, has this incredibly ambitious vision. He says he imagines a medical superintelligence available to everybody at their fingertips 24 hours a day. The stated goal is to replicate concierge medicine for the masses.
Which sounds amazing in theory.
Right. Now, Microsoft is aggressively promising that this sensitive health data will be kept strictly siloed from other Copilot conversations and absolutely won't be used to train their broader AI models. They've even built an internal clinical team and consulted with outside physicians to build guardrails.
They have to build those guardrails because the competitive landscape is already fiercely crowded. Amazon just rolled out a health chatbot, deeply integrating it with their One Medical primary care franchise.
Oh, wow.
Yeah, and OpenAI and Anthropic have both launched specialist health bots. The race to own the intersection of artificial intelligence and personal health is the next great tech gold rush.
But I have to ask a highly skeptical question here. We just talked about Nvidia dropping $26 billion to build the most advanced AI brains on Earth. And here, Microsoft is trying to be your bedside doctor. Yet, look at the actual demo Microsoft chose to show the public this week.
The jaw pain one.
Yes, they had a dummy patient complaining of jaw pain shortly after suffering a heart attack. And what did this highly advanced medical superintelligence say? It simply told the patient to get evaluated in person today, rather than providing any actual diagnostic insight. Aren't we just building a multi-billion-dollar version of WebMD? It feels like the ultimate corporate liability dodge.
This raises an important question, and it hits on the absolute core tension of deploying this technology in the real world. On one hand, you have the staggering technological capability of a model that can theoretically cross-reference a smartwatch's real-time heart rate variability with 10 years of a patient's blood panels in milliseconds.
Which is incredible.
It is. But on the other hand, you have the massive, immovable, real-world friction of clinical safety, corporate liability, and medical malpractice laws.
Right, because legally diagnosing a heart attack through a chatbot is a liability minefield that no tech company wants to step into.
Precisely. Microsoft desperately wants to disrupt the multi-trillion-dollar healthcare sector, but they absolutely do not want the legal liability of practicing medicine without a license.
So they play it extremely safe.
So safe. For now, you end up with a highly advanced AI that processes complex data only to ultimately just tell you to go see a human doctor. But this is a long game. They are starting as a cautious assistant to build consumer trust and aggregate the data. Over time, as the algorithms prove their accuracy and regulatory frameworks adapt to the technology, that boundary between a simple tech tool and an autonomous healthcare provider is going to heavily erode.
So we're watching the boundaries between hardware and software vanish, the lines between tech tools and medical providers blur, and the very foundations of our global supply chains violently shift. I don't know about you listening, but processing all of this reality is exhausting, which is exactly why 500 million people are actively retreating into a completely fictional reality to escape it.
Humanity will always need an escape hatch, and Netflix has engineered the most effective one on the planet.
They just announced a massive sequel to the animated film K-pop Demon Hunters. And calling it just a movie feels completely inadequate.
Oh, it is a global, cultural, and economic juggernaut.
That is putting it mildly. The sources show it is officially the most popular Netflix film of all time. Since its debut in June 2025, it has racked up more than 500 million views globally.
500 million is what?
Well, and Netflix partnered with Sony Pictures Animation on it, and the directors, Maggie Kang and Chris Applehands, are returning under a lucrative new exclusive multi-year partnership. But here's the detail that completely blows my mind and ties perfectly into our theme of collapsing boundaries today.
The band.
Yes, the fictional K-pop group from the movie, HU/NTRX, an animated group that literally does not exist in reality, hit #1 on the Billboard Hot 100.
Just let that sink in for a second. A fully animated, entirely fictional band topped the real-world music charts, beating out actual living human pop stars.
And it gets even crazier. Their lead single, Golden, actually won a real-world Grammy Award, and it was Spotify's 7th most streamed song in the entire world for the year.
Unreal.
Netflix Chief Content Officer Bella Bajaria noted that the film ignited a global fandom that crossed languages, generations, and genres. So what does this all actually mean for the economics of entertainment? I look at this and I think about the cartoon band Gorillaz from the early 2000s.
Classic example.
Right, but Gorillaz was ultimately an art project driven by real rock stars like Damon Albarn. A QNTRX is a pure corporate intellectual property machine, generating massive, high-margin revenue on Spotify, completely unbound by physical limitations.
That is the crucial distinction. The economics of IP that escapes the screen are staggering. A fictional band doesn't have touring logistics, they don't have vocal cord injuries, and they certainly don't demand a larger cut of the ticket
They
sales.
just exist and earn money.
Exactly. The boundary between a fictional narrative and the real-world music industry has completely vanished. This isn't just a cute movie soundtrack doing well. This is a fictional entity operating as a highly efficient, real-world economic engine. He2AX competes for the exact same real-world attention, streaming dollars, and prestige awards as Taylor Swift or Beyoncé.
It's surreal. Director Maggie Kang talked about her immense pride as a Korean filmmaker, that global audiences are demanding more of this specific Korean story. But the story has literally broken out of the television, bypassed traditional human constraints, and colonized the real-world charts.
And that brings our entire journey today full circle.
It really does.
Whether we are analyzing Delta's physical oil refineries, Nvidia's aggressive leap into software models, Microsoft's attempt at medical diagnoses, or an animated band winning a Grammy, the traditional lanes of business, technology, and reality are completely dissolving.
It's so true. Let's recap this map we've been drawing for you today. We started in the Strait of Hormuz, unpacking how a geographic choke point mathematically threatens the Fed with stagflation, forcing airlines like Delta to rely on their own internal physical refineries just to survive the shock. We examined Titted Solutions, struggling through a messy corporate merger, reminding us that the physical infrastructure of our world still requires heavily regulated human inspection, creating a moat against economic turbulence.
Yeah, that physical anchor's still there.
Exactly. Then we jump to the digital Wild West, where Nvidia is leveraging its hardware monopoly and spending $26 billion to shatter the boundary between silicon supplier and software competitor.
And we saw Microsoft trying to blur the legal and practical line between a search engine and a primary care physician with Copilot Health, battling the real-world friction of medical liability.
And finally, we watched a completely fictional animated K-pop band from a Netflix movie dominate the global streaming economy and win a very real Grammy Award, proving that pop culture boundaries are just as porous and lucrative as corporate supply chains.
And I want to leave you with one final thought to ponder as you navigate this rapidly shifting landscape. If Nvidia is successfully building its own AI brains to ruthlessly compete with its customers, and Microsoft is building AI doctors to manage your physical health, and Netflix has proven that entirely fictional digital entities can win real-world Grammys and dominate Spotify,
Yeah.
how long until an autonomous AI model writes, produces, and stars in the next billion-dollar global blockbuster, completely bypassing the human entertainment infrastructure altogether?
Wow. That antique map we talked about at the beginning, the water hasn't just spilled on it, the ink is completely washed away. We're all drawing a whole new map now, and the borders are moving every single day. Thank you so much for joining us on this deep dive. We'll catch you next time.